Hello, my name is Cesar Martin, and I will be continuing Chapter 11, Creating a Successful Financial Plan. I will be continuing with the ratio analysis, and we will continue with looking at the leverage ratios. First, we're going to speak of the debt to net worth ratio. And to figure the debt to net worth ratio, it's calculated as follows. Debt to net worth ratio equals the total debt or liabilities over the tangible net worth. What the debt to net worth ratio is the relationship between the capital contributions from creditors and those from owners and measures how highly leveraged the company is. The next ratio we're going to look at is the times earned interest ratio, and that is figured by taking the earned before interest and taxes over the total interest expense. And what the times interest earned ratio measures a small firm's ability to make the interest payments on debt. The next ratios we're going to be looking at are called operating ratios, and there are four. There's the average inventory turnover ratio, the average collection period ratio, the average payable period ratio, and the net sales to total assets ratio. The first ratio we're going to look at is the average inventory turnover ratio, and that is figured by taking the cost of goods sold over the average inventory. And what the average inventory turnover ratio measures is the number of times a company's inventory is sold out or turned over during an accounting period. The next ratio we're going to look at is the average collection period ratio. To figure out this ratio, there's actually multiple steps. The first step is to actually figure out the receivables turnover ratio. And to figure out the receivables turnover ratio, you got to take the credit sales over the accounts receivables. And what that does is it measures the number of days it takes to collect the accounts receivable. And then what you do is you take the receivables turnover ratio and you plug it into the next portion as well. You will then use the receivables ratio to help find the average collection period ratio. And the average collection period ratio, what you need to do is take the days in accounts periods and put it over the accounts receivables. The next one is the accounts payable period ratio, and similar to the average collection period ratio, this is a multiple step process. What the average payable period ratio does is it measures the number of days it takes a company to pay its accounts payable. In other words, it measures how long it takes a company to pay off their debt. And to find the average payable ratio, you first must find the payables turnover ratio. And to find the payables turnover ratio, what you do is you take your purchases and you put it over the accounts payable number. And you then use the payables turnover ratio to help find the average payable ratio. And to find the average payable period ratio, you take the days in accounting period and you put it over the payables turnover ratio. The next ratio we're going to look at is the net sales to total assets ratio. And this ratio is calculated by putting the net sales over the net total assets. And what this ratio measures is a company's ability to generate sales in relation to its asset base. Next, we're going to look at three different ratios, which are considered profitability ratios. Those three ratios are the net profits on sales ratio, the net profits to assets ratio, and the net profit to equity ratio. The first ratio we're going to look at here is the net profit on sales ratio. To calculate that, you put the net profits over the net sales. And what this measures is a company's profit per dollar of sales. The next ratio we're going to review is the net profit to assets ratio. And to find the net profits to assets ratio, you just put the net profit over the total assets. And what this measures is how much profit a company generates for each dollar of assets that it owns. And the final ratio we're going to look at is the net profit to equity ratio. And to find this ratio, you put the net profit over the owner's equity or net worth. And what this measures is the owner's rate of return on investment. When interpreting business ratios, you got to remember that ratios are a useful yardstick. Is a useful yardstick when measuring a small business's performance, and can point out potential problems before they develop into serious problems. Knowing how to calculate these ratios is important, but knowing how to read them and apply them to your business is key. Business owners must know and understand what ratios are critical to their business, and sometimes create their own unique ratios to help them succeed. An important factor is critical numbers, or key performance ratio indicators, KPIs. These indicators are used to measure key financial and operational aspects of a company's performance. When these numbers are moving in the right direction, a business is on track to reach its objectives. Critical numbers vary from company to company, even those competing in the same industry. Businesses must compare the ratios with other businesses in the industry in order to measure that they're actually being successful when it comes to the competition. Finally, what do all the numbers mean? What are all these ratios? We saw several. We saw probably close to a dozen ratios. What do they mean? When comparing ratios for the individual businesses to a published statistics, owners must remember that the comparison is made against averages. I mean, you're not going to get true numbers. It's most likely you're gonna in publications you're gonna see averages. Owners should strive to do better than the industry average. Owners must analyze their business's financial ratios over time, since ratios are snapshots of a company's financials, so that small shifts in the industry don't go unnoticed. In other words, these are just a moment in time. They could be from 3 months ago, 6 months ago, a year ago. Any little change in industry could shift these numbers dramatically. What you want to do is take a look at table 11.2 on pages 417 and 418, and they'll show you how to compare the ratios from operating data used in this chapter. The next portion of the chapter we're going to look at is the break-even analysis. What a break-even analysis is, it's a key component in every sound financial plan. First, before we know what a break-even analysis is, we have to know what a break-even point is. The break-even point is a level of operation at which a company neither earns a profit nor incurs a loss, meaning they zero out. To figure break-even analysis, you have to calculate the break-even point. You have to add in the profit. You have to, in some instances, some companies prefer to use units as opposed to actual dollar values. You should know how to construct a break-even chart, and you should know how to actually read and use the break-even analysis. Okay, first we're going to calculate the break-even point. To begin the analysis, the company must determine fixed costs and variable costs. Fixed expenses or costs are expenses that do not vary when changes in volume of sales with volume of sales or production. Variable expenses are expenses that vary directly with changes in the volume of sales or production. The first step in calculating the break-even point is you have to forecast the expenses the businesses can expect to incur. Again, these are your variable expenses. 2, you got to categorize the expenses estimated in step 1 into a fixed and variable expenses. You need to calculate the ratio of variable expenses to sales. And step 4 is you have to compute the break-even point by inserting this information in the following formula. Again, we're looking for the break-even sales, and to find the break-even sales, what you need to do is find the total fixed cost. Put the total fixed cost over contribution margin expressed as a percentage of sales. The next step in the break-even analysis is adding a profit. If the owner wants to do better than the break-even, they use this formula to analyze how they can adjust and modify the break-even formula to include the desired net income. So this is what you need to change up if you want to add a profit to your break-even analysis. What you need to do is put your total fixed expenses plus your desired net income over the contribution margin expressed as a percentage of sales. Okay. The next portion is the break-even points in units. Again, some businesses prefer to express the break-even points as units produced or sold instead of dollars. The formula computes the break-even point in units. What you do is the break-even volume is you put the total fixed costs over the sales price per unit minus the variable cost per unit. The next step in the break-even analysis is constructing a break-even chart. Kind of a long process, but at the end I do show you what a break-even chart looks like. The following steps outline the procedure for construction of a graph that visually portrays a company's break-even point. Step 1. On the horizontal axis, mark a scale measuring sales volume in dollars or units sold or some other measures of volume. That really depends on what the company prefers. Step 2, on the vertical axis, mark a scale measuring income and expenses in dollars. Step 3, draw a fixed expense line intersecting the vertical axis at the proper dollar value parallel to the horizontal axis. The area between this line and the horizontal axis represents the company's fixed expenses. Again, I know this is quite a bit, but I will show you on the next slide what one looks like. Step 4, draw a total expense line that slopes upward, beginning at the point where the fixed cost line intersects the vertical axis. Step 5, beginning at the graph's origin, draw a 45-degree revenue line showing where the total sales of volume equals total income. Again, your break even. Locate the break-even point by finding the intersection of the total expense line and the revenue line. And here is a picture of what a break-even chart looks like. This is in pounds. However, of all the examples I saw, this was by far the best one and the closest to what was spoken on in the previous slides. Finally, using the break-even analysis. The break-even analysis is a useful planning tool for potential business owners, especially when approaching potential lenders and investors for funding. The break-even analysis provides an opportunity for the integrated analysis of sales volume, expenses, income, and other relevant factors. The break-even analysis does have limitations. It is too simple to use as a final screening device because it ignores the importance of cash. In addition, the accuracy of the analysis depends on the accuracy of the revenue and the expense estimates. Finally, the analysis may not be realistic for some businesses due to changing sales volumes having no effect on the sales unit price. And that is the end of my presentation, guys. I know there is quite a bit of information on here, which is why I chose to actually do a visualized presentation. So if you have any questions or if you have any questions later on, you can go back, take a look at the presentation. Here's a reference that I used to pick out the break-even chart. And I will leave you guys time for questions. Thank you for your time.